The Australian Prudential Regulator has recently put forward proposals to phase out AT1s. But what does this mean for local banks' capital structures? Well, it's a good thing we have Himanshu with us today. Himanshu covers Australian banks for Bloomberg Intelligence. So maybe you can walk us through how did we come to these proposals?
Hi, Renato. Good morning. Thanks for having me. So, yeah, Australian regulator has always been like an outlier. So, the recent proposal is basically replace AT1 in banks' capital structure with Tier 2 and CET1 equity or common Tier 1 equity. And the reason they are doing it is because, unlike most jurisdiction, most countries, in Australia, the retail investors have material exposure to AT1s. So the regulator doesn't want to impose losses on uh, retail investors. And the reason this took market by surprise was when this proposal first came out last year. This was not even a question. Like what the regulator was planning was to think if we can somehow redesign the AT1 so that we don't have the same scenario that we saw with Credit Suisse. But when the proposal came out this year, when the second version of it came out, or the final version, they actually decided let's replace 1.5% of AT1 as a percentage of risk-weighted assets by 1.25% of Tier 2 capital, and the rest 0.25% by CET1 equity. So it was surprising, and it's basically if this thing goes through, Australia will be a country where there'll be no additional Tier 1 capital in the bank's capital structure. So yeah.
It's a long way. And Emma, how do you think these reflects itself in terms of along the capital structure? How would the securities react?
Sure. So again, it's positive for AT1 because we will not see any supply of additional Tier 1 capital, right? So what we expect is basically all the existing AT1s or hybrids, including COCOs, we have 2 or 3 outstanding in US dollars, those will tighten. And the reason I say that is because the regulator has imposed restriction on calling these securities before the first call date, and all the additional Tier 1 capital will continue to count as regulatory capital, but Tier 2 capital instead of AT1. So the banks still have incentive to keep them until the first call date, right? So these securities essentially until the first call date will trade as tier 2. So the phasing period starts from 27 to 2032, and we expect all 81 securities. We already have seen some tightening. If you look at Westpac's US dollar COCOs, they've already tightened about 50 basis point, but we still see 30 to 40 basis point of tightening ahead. And for tier 2, again, we're expecting some supply. We know that Australian banks, the big four, have about 38 billion in AT1, which they have to replace by about 22 billion of tier 2 capital. That's Australian dollars. So we're expecting some supply in other currencies, US dollar, euro, Australian dollar, pounds. So we expect some widening of tier 2, not significant because market can absorb that amount of tier 2 over the next whatever, however many years. But we still expect 15 to 20 basis point of widening for tier 2.
Perfect. Perfect. Thank you, Himanshu. You can follow Himanshu's research on the terminal under his bio page, or you can even find us this Thursday on our Global Financials webinar. This Thursday at 10 a.m. Eastern Time, 3 p.m. British Summer Time, and we'll certainly touch base on this as well.
Thank you.
Perfect. Thank you, Himanshu.
Thank you for having me.